Hi, how are you guys? Thanks for having me on again.
Thanks for coming back. So, what has been on your mind these last 2 weeks that, as far as how these I don't know, crazy trades sort of shook out? The story is not quite over yet. I mean, we're still learning new things all the time. The CEO of Robinhood, et cetera, are set to testify in front of Congress. But as far as how the story's played out these past few weeks, has anything surprised you on that front?
Yeah, well, I think there's obviously been this real emphasis on payment for order flow and whether or not it might lead to conflicts of interest between brokers and their clients and how they route orders and so on. But in my opinion, this is a story we've seen before. And look, let me just point out, this is not the first rodeo for payment for order flow by any means. Before you guys start with the hot takes on OK Boomer, let me just tell you about a lot of this actually goes back to like the 1980s when payment for order flow first started gaining some traction. And the NASD, which was the predecessor of today's FINRA, put together a blue ribbon committee. Was chaired by an ex-chairman of the SEC named David Reuter. And the Reuter Commission was basically set up. Sorry? The Reuter Commission was basically set up to look into this. And they came out with this big report in, I think it was '89. And there were three big takeaways. The first one was that payment for order flow was basically a means of returning outsized intermediary profits to brokers and their investors. Number two, that there were many different kinds of payment for order flow, and some of which would be hard to put a value on. And number three was that payment for order flow could be beneficial to investors by doing things like lowering broker costs, leading to free commissions. And here we are 30 years later, and that's pretty much what happened. So the SEC and FINRA have said for years that payment for order flow is fine, assuming, with two big caveats. Number one, that there's proper disclosure, that the brokers tell their clients that they're receiving payment for order flow. And number two, that it does not interfere with obtaining best execution of the client orders. And that's the key thing to watch for as we go forward and see these congressional hearings and so on, because that's really, I think, what they're going to hone in on. Are clients getting the best execution? And, quite often, best execution, you'll hear the term price improvement and how much price improvement are orders getting and so on. And just recently, we've learned that several brokers have started to disclose, Robinhood, Schwab, Ameritrade, these price improvement numbers that are much higher than people have thought, which is a good thing for investors. And so the interesting thing is going to be to watch when you see these hearings is that the regulators, the SEC and FINRA, they've known about this for years. They've been surveilling it. They, when necessary, they swoop in and levy fines and so on. It'll be interesting to see if they have to defend what they've done to Congress. It should make for some very interesting viewing.
I just got a couple comments there too, Bill, and I agree. Like what I see, and obviously I've been a big critic of payment for order flow for a long time, but I do see the improvement that you're talking about. Like I used to see when we started talking about this, Joel, back in like 2009. You'd see what I would call like sub-pennying the quote, where you're seeing this 0.0001 price improvement. And I did like a study with Bright Trading. It was like something like 28% of orders were getting like 1/1000th of a penny price improvement. I was like, is this price improvement 0.0001 really enough price improvement to justify taking a fill away from a displayed liquidity provider? And I've argued that for a long time. But what you're arguing is that you're starting to see more competition here, and you're starting to see that PI. You're not seeing as much of this 0.0001 stuff where somebody's just effectively trying to jump the lit order queue by giving a fraction of a cent better. So you're actually starting to see more competition, and you're starting to see the PI more significant than this 0.0001 stuff that we saw for years.
That's right. I think that the brokers, the market makers, have evolved to a point where they really are giving back significant amounts of PI, between 2 and 5 cents a share when you look at Robinhood and Schwab and Ameritrade. And I mean, that's on average, and it generally goes by a percentage of the spread. So no one should expect to get 3 cents price improvement on a stock with 3 cents spread. That makes no sense. No. But But in general, I think we are seeing significant price improvement now. But when you start watching these hearings, I think what people have to keep in mind, and I like to say this, is you have to say, well, price and payment for order flow, maybe it's good, maybe it's bad, but compared to what? And ask yourself, what would happen if Congress or the SEC or someone decided to ban hard cash payment for order flow? And it's actually a good mental exercise to do this, because these are the questions that the Congress people and the senators are really going to come up on very quickly. So let me just give you a couple of quick bullet points on this. So if you banned payment for order flow, hard cash payment for order flow, early on, what that would mean, it would be a windfall for the market makers, because market makers have proven that their execution quality is as good as or better than what you can get on exchange. So brokers would probably continue to route to them to get best execution, but they no longer have to pay for the flow. So it would save themselves a bunch of money. And believe me, I'm not trying to hype Virtu stock, but just imagine what would happen to their valuation if you added back all the PFOF money that they currently pay out. So that's number one, and that would become apparent pretty quickly if they eliminated payment for order flow. Number two, brokers could set up their own internalization desk upstairs. This was very common in the 1990s. Every broker, Merrill Lynch, they all had NASDAQ desks upstairs. And so they basically internalized their own flow. It's a little harder to do that today. It's expensive to set up. You need some rocket scientists to figure out the algorithms. But theoretically they could do that. But here's another thing that could happen if hard cash payments were made illegal. Basically, the brokers who currently route to market makers could own a piece of a company that is a market maker or an exchange. And therefore, if that company made a profit, they would share in the profits through their ownership, and they would still direct their order flow to that company. So the big example of this was, everybody remembers Knight, I'm sure, the nightmare where an algorithm went haywire and basically put the company out of business. Knight, for a long time, was one of the leading market makers of NASDAQ stocks. And it was actually formed by 27 brokers who got together. It was called the Round Table Partners. That's how it became known as Knights of the Round Table. And these brokers basically said, okay, look, we're going to build this market maker, and if the market maker makes money, we'll share in that, and we'll send our order flow to it. And that was very successful for a long time. Today, you don't have that right now. It could happen. You have broker-owned exchanges like Memex most recently, and MIAX also is partly broker-owned. So there are different ways to skin that cat. But let me just point out, from a disclosure perspective, that these things are worse than payment for order flow, because at least with payment for order flow, you know how much money is changing hands. If some firm sets up an upstairs trading desk, you don't really know how much they're making from it. There could be all kinds of costs loaded in, and it'd be very hard to disclose it. So anyway, at the end of the day, what I think is going to happen is you'll see increased attention to the practice. There'll probably be another blue ribbon panel set up to study payment for order flow again. Yeah. But at the end of the day, there'll probably be little change from Congress or the regulators.
I think you make a great point with, and obviously my concern overall is the toxicity, and we know we're going to start to get ahead of our listeners, so we've got to bring it down a level maybe. But, I'm concerned that there's so much informed traders just on the exchange, and all the uninformed flow is being kept off the exchange. So as a market maker, as a lit market maker, if you're making markets on the exchange, you don't want to trade, with informed traders. You don't make money trading against other prop traders. You don't make money trading against informed traders. As a market maker, you make money trading against uninformed flow. Typically, retail is more that flow. That flow being kept off the exchange is what I say increases the toxicity of order flow on the exchange and makes it less attractive for firms like ourselves to provide liquidity. So to put it in perspective, because the way the markets have evolved over the last 11 years and so much retail flow being kept off the exchange, our firm has went from primarily providing liquidity to primarily taking liquidity. We've adjusted to the environment, and our traders are doing very well, but we take liquidity. We lift the offer, we hit the bid, we maybe go 2/3 through if we're small enough to not affect it, but we're coming through. as opposed to sitting out there. So the point you were making is, even if you get and you ban payment for order flow, that those orders, those retail orders, are likely not coming back onto the exchange. And I think a main reason for that too, which we haven't talked about, is access fees. Is you can't have, Robinhood routing out to Arca and paying 0.3 of a penny to get filled on that order. They're going to get crushed on that. So, I mean, if you're going to ban payment for order flow, you've got to look at the access fees on the exchange too and say, well, you got to ban them as well. You can't just take away the payments that way, because you can't obviously the brokers are never going to route anything to the exchange in any regard, because they don't want to make those payments. So you can take away their gravy train, maybe the PFOF, maybe they got to add some commissions. But like you say, they're probably still not routing their orders to an ARCA offer or an offer that's they got to pay 0.3 to take it. So I think
you're making a great point. I mean, look, when all this started, the exchanges were considered the gold standard of execution quality, and it was up to the market makers to prove that they could do as well or better than an execution on an exchange. Mm-hmm. Today, I think it's all sort of flipped on its head, where the market makers are generally considered to have the best execution quality, and it's up to now to the exchanges to give a good reason why a broker should route to them, whether or not they pay payment for order flow. And they do, by the way, they're called exchange rebates. So, but I get your point. If liquidity, if orders continue to drain away from the exchanges, what will happen to the quality of price discovery? I think there are mechanisms in place that will ensure that the exchange quotes will continue to reflect what's happening off exchange. But that's another topic that the regulators are certainly.
Bill, let me hop in here for a second. We're on with Bill Harts. He's a former CEO of Modern Markets Initiative, and I might be a little off base here in some of my assumptions here, but Dennis, you can correct me if I'm wrong. So, these one thing about trading, let me make this statement, whether you're a short-term trader, long-term trader, one thing about trading is like taking losses, right? I mean, whether they're small losses or big losses, invested in discipline, right? But when I kind of look at like the payment for order flow, it's like I kind of feel that they can't lose. Like almost every trade, almost every execution, they make money on. And if they can't do that, or they can't break even, then they pass it on to the exchange. So I'm not saying it's riskless trading, and I might be a little bit off base on this, but when you have the option of taking the other side of a trade or passing it on to the street, that's not an even playing field for you.
Yeah, that's why we can say there's lots of PI, but also we can look at the bottom line. A lot of these options they made a lot of money. Yeah, I mean it's such a good system for an off-exchange market maker. We don't have to name them here. You guys know all the ones we're talking about. But, I mean, it's such a huge edge to be able to take the other side, to have that option, to take this other side of this trade coming through. And, again, when you're looking at retail, you're looking at a smaller trades typically. So it's, when you're taking the other side of a trade, and it could be an institution coming through, you don't know, like you sell it here, they're coming with more, and they're coming with more, and now you're getting buried. Where typically smaller retail traders, it's going to be back and forth. Just like even, the stats that we were looking, from Citadel with GME. I mean, that was pretty even, the buying and selling. So that's ideal for a market maker because they can keep flipping out on the bid and the ask.
Yep.
So I think what Bill's saying is if you get rid of payment for order flow, I don't know if that, goes away. I don't know if that goes away by just eliminating.
If you're getting proved 0.3 of a penny on something, that means that they made 0.6 of a penny.
It is. They're making the spread.
I mean, it is.
You're right.
I mean, don't tell me about price improvement at 0.3 of. The only reason you're getting that improvement is because of whatever market dynamic was. If they had another order in the book, they're not giving you the brokers that advertise that. Price improvement. Well, you're not getting your full price improvement, and there's nothing you can say that would convince me that every price improvement that they get on these executions is passed on to the brokers and passed on to the customers.
They're making on the spread. You're arguing that point. So let's let Bill address that.
Yeah, no, I mean, look, I understand what you're saying. I think the first thing that you have to understand is that over the course of a day, a market maker is up and down all the time, right? They're not profitable on every trade.
For
it's
sure.
not the way it works, right? And so there's nothing that says, oh, market maker looks at an order, if this isn't profitable, he passes on to the exchange. That's not what happens. And in fact, the amount of flow that market makers pass on to the exchange is a small fraction of what they generally trade with every day. But in terms of you being skeptical about how much price improvement you're getting, what I would say is do a test, right? Send one order through Robinhood or Schwab or Ameritrade and send another one where you know it's going directly to an exchange and see how they both come back. And I think what you'll find is that in general, the market maker trades are going to be better prices.
Yeah, well, it's the difference between markets and limits, right? Because typically, and this is something that's been said for a long time. I mean, the off-exchange market makers are buying market orders. The exchanges are buying limit orders. I mean, that's really what you're doing by having rebates attached to those. So, like, you just look at what Joel's saying is, you got this market maker that it's a big edge. I mean, it's a big edge for sure on the spread. It gives you a big advantage, but they're paying for that advantage. So they're not doing this out of the goodness of their heart. They're not giving the PI out of the goodness of their heart. But I see Bill's argument that even if you get rid of the PI, they're probably still getting those orders, so that stuff isn't going away. We're not going back to the days where 100% of the flow's going to be on the exchange anymore. That ship has sailed. Like I argued that for a long time. I wanted to bring flow back onto the exchange because I thought price discovery's being impaired. In the small cap names, and some of them it probably is to a certain extent, but it's held up very well in a lot of other names. So there's good arguments on both sides. I see both sides of this.
And one other thing too is like when things really get crazy and stuff, these guys don't have an affirmative obligation. There used to be market makers that had to post a two-sided market, and even when things got wild and you were getting like picked off, there's no affirmative obligation. Hey, this is getting let's shut her down for a little bit. I mean, that's another thing that is a little
well, you could take it a step farther too. Maybe Bill could address that too. Is the off-exchange market maker not even about affirmative obligations? They're not even posting a market. I mean, they're basically free riding on the public quote. So you're not even posting a market up there. So the risk. And, we've been market makers for a long time, Bill. But it's true though.
When we talk about affirmative obligations, generally, what you're going back to are things like what exchange specialists used to have, right? And it wasn't so much to make a two-sided quote, although that was part of it. And by the way, today, market makers, of course, are always publishing continuous two-sided quotes. In fact, they'll often post quotes deeper than what the NBBO quote is.
The lit ones, but the off-exchange ones don't have to.
No.
Yeah. Most of the off-exchange market makers are lit market makers too, though.
Right.
So they're on both places.
My point is that maybe in the old days with the exchange specialist, there was an exchange rule that said, you couldn't move a stock by more than an eighth or a quarter, right? We were talking about, 12 cents at that time, 12 and a half cents, without some intervening trade. That was what was known as an affirmative obligation. Yeah. Today, we've sort of evolved to a point where, spreads are so narrow that maybe that's not as important anymore, but maybe depth at the inside is more important. And so market makers, as a competitive measure, often will execute trades that are much larger than what's shown at the inside. So I would argue that there are these obligations. Maybe they're not written down somewhere, but in fact, the retail investors whose orders are being sent to market makers benefit from them.
I mean, that's size improvement you're talking about, and that's another argument for, like I said, I can see both sides, and I think there's a happy medium of, where the markets are most efficient to have a certain amount of volume going off exchange and a certain amount of volume going on exchange. Do we want to go back to 100% on the exchange? It's not going there, so it's unrealistic to hope that would happen. But, at a certain point, is there a tipping point? I'll just maybe finish with that. Is there a tipping point if we start seeing 70, 80%? I mean, we're at 44% or something right now. If we start seeing like 3/4 or 2/3 of our orders going off exchange, is there a tipping point where it does start to impair price discovery?
Yeah, I don't know that there's a set point. I think we're closer to 50 right now. But
okay, so it's going up.
It can be measured in shares. It can be measured in notional value. There's a lot of haziness around. But I don't know. I think, look, a lot of people don't realize that even when a market maker holds a limit order off exchange unexecuted, that limit order still has to be reflected in the NBBO on exchange. So the price discovery mechanism actually, would still be happening even though that order is not literally on the exchange. So hard to say at where there would be a tipping point. I'm not sure there is. I think, it's something that obviously the regulators pay a lot of attention to.
Well, it's been a great conversation. I know we're going above the head of a lot of listeners here, but I think sometimes we got to dig into the plumbing. I mean, digging into the plumbing, and Bill's a great plumber here, and I respect Bill Harts so much. I've followed him for years on Twitter. Give him a follow here. He knows his stuff. We're kind of on the opposite sides on this argument. I'm on the same side as Bill on a lot of stuff. I see as a point here, though, on payment for order flow. So, Bill, I just want to say thanks again for coming on. We want to have you back because I want to talk financial transaction tax with you next time.
Yeah, we should talk about the FTT. Right.
Yeah, for sure. Thanks so much, Bill.
Thanks, guys.